Hello everyone, welcome to financialexpress.com special budget series. In the budget 2015, Finance Minister Arun Jaitley had said that he will reduce corporate tax from 30% to 25% in a period of 4 years. Well, this year will be his last final budget, full year budget prior to the 2019 general elections. Whether he will reduce corporate tax by 1 or 2 basis points, 2 percentage points, to answer all these queries, we have with us Srinivasan ANAND.G, chartered accountant and author with Taxman. Welcome, sir.
Good morning, sir.
My first question to you is, sir, do you see Finance Minister Jaitley bringing down corporate tax in this year's budget?
Quite possible, because though the effective tax rate may be less than 30%, but due to the various exemptions, the 30 always acts as a psychological barrier. Not that if corporate tax rate alone is lowered, many will attract investments. There is a lot to be done to attract investments, but this acts as a psychological barrier. So there is a chance that he may lower it, and this will be accompanied by grandfathering of the various tax holidays and various exemption provisions in Chapter VIA of Income Tax Act and also Chapter III of Income Tax Act. But that rates is only part of the problem in taxation. Modern thinking that we see among people is that they want a less complicated tax regime. They don't mind paying more tax. That is what we discovered during the Gujarat elections, when a trader from Surat said, we Surtis always pay more tax than anybody, but we only complain against the paperwork. So this has become the trend today, that one, they want delivery of services, and second, they want a hassle-free payment, this thing. The problems in corporate taxation today is that, on the one hand, the Ministry of Corporate Affairs has notified the accounting standards as per which the accounts have to be prepared. So one of the arm of the government says these are the standards as per which your accounts have to be prepared. Then you have the spectacle of another arm of the government distrusting the standards notified by one arm of the government and coming out with its own income computation and disclosure standards, which are a poor copy of the accounting standards that have been notified under the Companies Act. Not only that, this income computation and disclosure standards, they fail to meet the basic norms of meeting the wires of the Constitution also, and wires of the Section 145(2), under which they have been notified. Now, Delhi High Court, in one of the writ petitions filed by Chamber of Tax Consultants, they struck down various provisions of the income computation disclosure standards as going against the court decisions which have been rendered under the substantive provisions of the Act. They say that if the court decisions can be overcome but it cannot be overcome by a delegated legislation. The rules, the income computation disclosure standards are delegated legislation, whereas Income Tax Act is the supreme legislation. Article 265 of the Constitution says no tax shall be imposed save by law. So there has to be a law passed by Parliament to impose a tax, or by the appropriate legislature. Now, whatever overcoming of the judicial precedents have to be done, they have to be done by validating legislation has to be passed by Parliament. You cannot go through the delegated legislation route of income computation and disclosure standards to do this. So there will be various curative amendments in Income Tax Act to overcome the impact of these decisions and to overcome the various judicial precedents. And there will be some curative amendments to 145(2) to enable them. But government could avoid itself getting into this rut by having two regimes, one normal computation regime and one MAT regime, computing whichever is more favorable to revenue, and if MAT is more favorable, applying MAT. Let them apply the MAT regime as the only regime that is applicable. Let them make the normal regime applicable to other assessees, inapplicable to companies, because your company's accounts are prepared as per the accounting standards, and even MAT recognizes the accounting standards. So scrap all these income computation disclosure standards for companies and let them have the only regime as the MAT. Let MAT be the only tax, not alternate tax, but only tax, not minimum alternate tax, but let that Section 115JB be the only tax, and to which they can throw in the transfer pricing adjustments and have a proper this thing. This is the short-term solution to it. Long-term solution is to have a separate corporate income tax code which recognizes the book profits, which recognizes that qualifications made by the auditor will be adjusted to it, which recognizes that NFRA can go into the balance sheets and determine what adjustments are required, and if the assessee has a problem with it, he can go in appeal, have that kind of a regime in the longer run. But the short-term solution seems to be to align the whole taxation with the section 115 JB and delete all the alternative provisions. But this simplification seems to be more important than even reducing the tax rate, because the mess is too much. You have they are already complying with accounting standards. The accounting standards have the basis of a consensus of so many years. They have evolved by accounting bodies, by all taking large number of people into consideration. They have the consensus of the business community. They have the statutory backing of the law. So treat the accounting standards under the Companies Act as the base and make this whole thing, income computation and disclosure standards, inapplicable to the companies at least. Because you already have, what is the meaning of a standard? If you are not going to use that as a benchmark, then it makes nonsense of the word standard.
So, sir, that brings me to my next question. My next question is, if he reduces corporate tax, so which are some of the sectors that will benefit from this move?
Generally, all sectors will benefit. More importantly, the real estate sector will benefit, because even the RERA has come. So more and more people will corporatize their firms into companies, and the company creates a better image in the minds of an average person than having a firm or a proprietorship concern. So it will help, particularly real estate. It will help because more real estate firms will get corporatized, and but it will generally have a favorable aspect in all parts of the economy.
So recently there has been a reduction, a talk of reduction of corporate tax in US from 35% to 21%. How does that impact Indian companies or India? Can you elaborate on that?
Basically, the one thing must be understood here, that there is the transfer pricing regulations. In transfer pricing, Australia has brought about a diverted profit tax bill 2017 last year, and multinational tax bill last year. Whether that kind of legislation can be enacted remains to be seen in our this thing. But Australia basically enacted those things because they felt that their general anti-avoidance provisions, anti-avoidance rule provisions, had some shortcomings, and which could not tackle the sophisticated tax evasion through, instead of directly sourcing from a parent entity, they can go for, they do it through via different country, which has a lower tax base. So all these things were tackled by Australia by bringing in a diverted profit tax act. It remains to be seen whether such provisions will be introduced in our transfer pricing legislations along those lines. That is one part of the thing. Second part of the thing is that how far, if there is a conflict between GAR, if there is a problem in these matters, will GAR be invoked indiscriminately? Right. Because the GAR is general anti-avoidance rule, and transfer pricing is a special anti-avoidance rule, SAR, SAAR. Now, if GAR conflicts with SAR, what should be the position? Canadian court ruling says that GAR cannot make up for shortcomings in SAR. So if a taxpayer avoids the shoals of SAR, you cannot then catch him in GAR, and there is merit in the decision. Because if you say that wherever SAR fails, I will apply GAR, that means you are in essential saying that the words of the law have no more any meaning. And you are making nonsense of the constitutional mandate that tax can be imposed only by a specific provision of law. And Article 265 of India has much the same import. So, if you are, our CBDT has answered it vaguely, saying it depends on the facts and circumstances of the case. But this is no answer. Any sane jurisprudence, they should clarify that where SAR is applicable, GAR will not apply in that field. So they need to first clarify this. And they need to bring in some kind of a SAR like the diverted profit tax to meet whatever gaming may happen. But as I said earlier, tax rate is not the basic issue again. It is the simplification of the regime. And I see no reason why we can't have a world-class regime, why we can't pioneer a world-class corporate tax regime, because we have the accounting standards notified under the Companies Act, which are sacrosanct rules to be followed by companies. So when you have these principles notified and it has statutory backing, it is also not the case that it is just a persuasive set of rules formulated by accounting body like in other countries. When we have taken the lead in notifying these as the standards according to which business profits have to be computed, we should stick to them. And now that you have the National Financial Reporting Authority under the Companies Act, the NFRA is competent to act against the auditors. So now why are you having distrust of the audited accounts? Why are you not taking that as and bringing your taxable profits as near to the audited accounts as possible? So this simplification in regime is more important in attracting investments than merely reducing the tax rate. But all said and done, whatever gaming will happen, and another aspect here, in transfer pricing, our transfer pricing rules only talk about price adjustment. That if the price is not at arm's length, you substitute the arm's length price and compute the profits. This is what we are having in our transfer pricing regime. But the treaty provisions in many double taxation agreement treaty, it says that conditions which are not at arm's length can be adjusted. Now, when there is a treaty, can you adjust the profits for non-arm's length condition? Now, in Chevron case of Australia, Chevron, there was a judicial decision. In Chevron case, what happened? They had the interest rate was at arm's length between the companies, but they had not inserted provisions as to security and creditworthiness, which you would expect in a normal arm's length transaction. So therefore, adjustments were made based on the treaty clause. Now, question arose that independent of treaty equivalent transfer pricing rules, can such an adjustment be made? The court ruled it cannot be made, that you need, based on just a treaty clause, you cannot make it if domestic transfer pricing legislation of the country forbids it. So we need to have treaty equivalent transfer pricing rules like Australia if we want to adjust for conditions other than price, which are not at arm's length. Now, even Delhi High Court in one of the rulings, it said that arm's length only it's a price substitution exercise. So you cannot adjust for conditions other than price as it stands today, as per the Chevron ruling, which will be cited very often by our people when they argue the cases. So there is essential that government brings treaty equivalent transfer pricing rules also. So if they want to adjust this part.
Okay. Sir, my next question is, if Finance Minister Jaitley reduces corporate tax, will it substantially affect government coffers?
Well, actually no. Because you see, when you reduce the Corporate Tax Act, many people who might have been waiting for that reduction to put their money in, they will put their money in. So there will be more number of companies. You see, either you can have a very big slice of a very small cake, 50% of a very small cake, or you can have a small size of a very huge cake. So it always makes sense. And if nobody is going to come and manufacture in your country, then what do you realize out of it? When economic activity takes place, then only the tax revenues come in. So by lowering the tax, if you are able to get more investments in, and which will happen because many people may be halting their investments only because of the tax rate, it's quite possible. Those investments will flood in and the cake will become much larger. And 25% of a much larger cake makes more sense than 30% of a relatively smaller cake. So government might be factoring that aspect in, and they would go for the reduction.
Thank you, sir, for answering all our queries. For more news and updates, log on to financialexpress.com. Thank you.